Hello everyone, this is the third video in beginner series. This video is about risk management and profitability. So this is part one of the two videos which I'm going to make on risk management. So let's begin. Let's talk about elements of successful trading first. So the first element is trading edge. Trading edge is basically uh, you need to know in which direction market is about to make a move. You need to have a basic idea about the current trend or upcoming trend change. If you don't know in which direction you are going to trade, then obviously none of the other things will work. Second thing is timing. Now, even if you know the particular direction of trend or the reversal trend, if your timing of entry is not correct, then you might lose some money because of a continuous manipulation in the market, because price moving up and down continuously, it might make you doubt your decision and you might lose money. So timing is also an important part for trading successfully. Third thing is emotional control. So we might have seen on the charts that price is continuously getting manipulated by market makers. They'll push the price above resistances or below supports to give you idea, to create an idea of breakout or breakdown in your mind, but then the price retraces back quickly and the breakout traders are trapped. So emotional control is very important for trading successfully. To to have emotional control, the best way is to have a set of rules on which you need to enter. If particular trade doesn't satisfy those rules, then you don't enter. Now the fourth and most important part that comes is risk management. So in this particular video we are going to focus solely on risk management. So what is risk management? Risk management strategies are basically plans and strategic actions that traders and investors implement after identifying investment risks. So basically, risk management involves identifying, evaluating, and mitigating the risks when the market moves in opposite direction to what a trader has predicted. By implementing these strategies, you are looking to minimize the losses when the market is moving in opposite direction. Now let's understand why is it necessary to manage risk. Once we start losing significant chunk of our portfolio, then it will require greater effort to even get back to the break even value. For example, if we lose 20% of our capital, then even to get back to the original portfolio value that we had, we need to make 25% profit on the remaining portfolio value. Similarly, if we lose 50% of our portfolio value, then we need to make 100% profit on the remaining value to even get back to break even value. So it is necessary to manage the risk and lose capital in a systematic way if we are on wrong side of trades, instead of losing bigger chunks in less number of trades. Now let's study some elements of risk management one by one to see how do we manage risks. First thing is the use of protective stops. Protective stops are nothing but stop losses that we apply on our trades. A stop loss point is basically the price at which a trader will sell an asset or buy an asset and take a loss on that trade. This often happens when a trade does not pan out the way a trader hoped. The points are designed to prevent that it will come back mentality and limit losses before they escalate. For example, if a coin's price break below a key support level, traders often sell as soon as possible instead of hoping for the price to come back in their favor. I'll explain using the stop losses on the chart. Now let's see how to decide where to put the stop losses on a chart. So let's assume this horizontal line is support. Price moves to this support, bounces from here, then again later price goes down below the support and then quickly comes back up. Then price is moving up and consolidating, then price is again trying to move toward this support. Now how will we decide where to put our stop losses? So what many traders do is they are assuming that price is again going to bounce from the support. So what they do is they put the stop losses randomly below this support line, or they put the stop losses on the basis of their loss. For example, if price is going 2% below, they are going to lose some fixed amount, like at 10x they will lose 20% of the margin, and they are going to put the random stop loss here, which is incorrect. Stop losses should not be on the basis of your loss. Loss should be considered, but first thing that has to be considered is invalidation of your idea. So as here we can see price move down till here, there is some liquidity here, so price might try to sweep this liquidity. So your stop loss should always be below this. If this is a wick, then below this wick, and just not exactly below this wick, little a little bit down further. Now you for example, you are deciding this to be your stop loss 4.8, then you will try to calculate how much loss you will take from here to your stop loss point, and then you are going to manage your position size on the basis of your risk, which I will explain later in this same video. This is regarding a key level. Same thing applies if you are trading on a trend line. Same thing is there. Suppose there is a liquidity sweep like this, then you are for next time you are taking a support on this line, then your stop loss should be in the similar way below any major liquidity. So for any trade idea, for example, you are trading on the basis of fib levels, then if your fib level is broken, for example, you are taking a trade on this fib level, and if your fib level is broken, then your idea is invalidated, then your stop loss should be on the basis of that. So the crux of uh, this is your stop losses should not be random. Your stop losses should not be on the basis of how much loss you are taking. Stop losses should be the invalidation of your trade idea. Then after you are choosing a level where your invalidation is occurring, then you are going to manage your risk according to your position size. Now next risk management element is risk per trade or 1% rule. So if you want to be a trader and not a gambler, your number one priority should be protecting your capital. This is why you have to consider the risk you are taking while trading. Risk per trade is how much of your capital you are willing to lose on a single trade if your trading idea is wrong. Now, the big wallets follow 1% rule, which basically means they only risk 1% of portfolio on a single trade. For small accounts, 1 to 5% of risk should be taken based upon RR of setup. RR is a risk to reward ratio, which I will explain later. Now, fixed risk helps because of power of compounding. On continuous losing trades, your losses become smaller and smaller, and on your wins, your risk and hence the reward keeps getting bigger. So if you are taking continuous losses, then your portfolio size will decrease. Then 1% of your, suppose you are taking the risk fixed 1%, then 1% of your portfolio size will also keep on decreasing. And when you are taking continuous wins, then similarly your portfolio size keeps on getting increased, and hence 1% of your portfolio size also increases. So this way, by compounding and decompounding, risk management helps in growing your portfolio. So the risk per trade which I follow is for altcoins. I usually take 1 to 2% risk. For very low cap coins, I only take 0.25 or zero point 0.5 or 1% on the basis of RR and trade conviction. And on Bitcoin and Ethereum, I can take high risk like 3 to 5% on the basis of how sure I am about the trade and how good is RR. So you always have to manage your risk like that. And if you want to fix your risk per trade, then that also you can do, but you have to follow it with discipline. Now, next thing is risk to reward ratio. RR ratio represents the ratio between risk you are taking and the expected return. It basically compares your potential profit with potential loss. It can be easily calculated with long and short position tools on TradingView, and you can also calculate it manually using this formula. So I'm going to show you how to calculate your risk to reward ratio on TradingView. You should be looking at setups with high error to be profitable. So risk to reward ratio and your win rate, they are correlated, and this correlation, managing this correlation will help you to become profitable. I'll explain this. First, let's go to the chart to see how to use long and short. So again, for this example, we are considering the same SNX chart that we saw earlier. Now, for this chart, in this toolbar, side toolbar, we can see here we have long position and short position tool. So I'm taking on idea of long position, so I have chosen long. Now how do I use it? I simply click at the point from where I want to take the entry. It is going to draw a long position tool. Now where I want to take my TP, I will drag this green box to that point. For example, I am considering taking the trade up to the mid range, so this is my exit point or TP point, and similarly my stop loss should be below this wick. So for example, till here I'm taking my stop loss, so this is my entry, this is my take profit, and this is my stop loss. Now as you can here see, risk to reward ratio is already calculated here, which is 2.72. Basically means for every 1 unit of risk I take, I am getting 2.72 unit of profit. We always have to look for setups which have RR greater than 1 is to 1, basically which have more reward than risk. I prefer setups with 1 is to 2, 1 is to 3 and higher ratios. I preferably take the trades which minimum has 1 is to 3 risk to reward ratio. Now we can also calculate how much profit and loss we are going to make. We can go to the settings, we can set here our account size, suppose $1,000. Suppose I'm taking 2% risk. Then we can also see how much amount we are going to uh, gain and lose if our trade goes in profit and if our trade goes in loss. For example, if we hit TP, then our amount will increase to 1054. That means we will gain $54, and if we take a loss, then we are risking only 2% of 1000, that is just $20, so we'll have $980 remaining. So this is for long trade. Similarly, in the same way, we can take for a short idea also. We just need to do the same thing. We have to drop the tool. Now the green box is our TP, red box is our stop loss. Suppose this is my trade, I'm shorting at this line, mid range is my TP, and this is my stop loss. So this is 2.93 risk to reward ratio, which is a very good trade. So similarly, in this way we can calculate a risk to reward ratio for trades. We can plan it in advance before taking the trade, and on the basis of this we can decide whether to take this trade or avoid it. Now let's talk about RR and win rate correlation. So win rate basically represents the number of winning trades out of total number of trades taken. For example, if a trader executes 100 trades and 40 of them are profitable, then his win rate will be 40%. Now as we can see in this table, uh, so if we have lower win rate like 20%, 30%, 40%, then if we are taking higher risk to reward ratio setups, then eventually we'll be profitable. But if our win rate is poor and also we are not choosing trades properly, we are choosing the trades which have low risk to reward ratio, then cumulatively we'll either be in loss or we'll be at break even. So we have to manage a combination of these two. We have to check, we have to calculate what our win rate is. We have to find that out. Then according to that, we need to choose the setups that suit our win rate. For example, let's say our win rate is 60%, then we can take the liberty of taking setups of 1 to 2, 1 to 3, 1 to 4, and even we can take the risk of 1 to 1. But if we have, let's say, 40% win rate, then we have to avoid the setups which has 1 to 1 risk to reward ratio. So in this manner, you have to find the correlation for your trading style, and then you have to manage your trades according to that. You have to choose your trades properly on the basis of risk to reward ratio. Now the next risk management element is position size. Picking a correct position size is probably the most important thing when it comes to managing your risk. This can be done with a very simple position size calculation. This position size calculation tells you how big of a position you can open in order to only lose the amount of risk which you have previously decided on. Keep in mind that leverage does not affect the position size. This is how position size is calculated. Position size is basically your capital at risk divided by distance or percentage to stop loss. I'll explain this with an example. Suppose you have an account size of $5,000 and your risk is fixed at 1%. So basically for each losing trade, you only want to lose $50, which is 1% of 5,000. Now suppose you are taking any trade, suppose you are taking a long trade and your stop loss or your invalidation point is 5% away from your entry. Now 5% means 0.05. Now how you calculate position sizes? Your capital at risk, that is 1% of your account size 50, divided by your percentage to stop loss, that is 0.05, which comes out to be $1,000. Now you have calculated your position size. Now you can take your trade on any leverage base on the basis of this position size. For example, if you want to take a trade at 10x leverage, then you have to use $100 margin so that your position size remains $1,000. Position size is basically your margin which you are trading with multiplied by your leverage. So you have to manage your leverage and margin in such a way that your position size remains $1,000. In this way, you will only lose $50 if your trading idea is invalidated. So this is how you have to calculate your position size every time. So this is a long trade which I took earlier today of FLM at this particular point. Now let's calculate our position size and risk to reward ratio for this trade. So I wanted to take a long here and I wanted to take my profit at 0.11, and my stop loss was below this, somewhere around here. So as we can see, this was a very high risk to reward ratio trade, 5.88 RR. Now assume I am entering with a position size of $100. So my stop is 3.75% away. Let's change it to 4% for the sake of easy calculation. Let's say my stop loss is somewhere around here. Okay, assume it's 4%. Now how do I calculate my position size? So suppose I have a portfolio of $1,000 and I want to only risk 2% of this. So 2% of $1,000 is $20. Now, how do I calculate my position size? Position size is basically your risk amount divided by your percentage your stop loss is away from your entry. So it will be 20 divided by, we have taken 4%. 4% is basically, you can take it like this: 4% is 4 divided by 100, which is 0 0.04. Now, to calculate your position size, you will take your risk amount divide by percentage SL move, which will be basically your 20 divided by 0.04, which is 20 multiplied by 100, 2000 divided by 4, which is $500. So this is my position size on the basis of my risk. Now we have a portfolio of $1,000, and to enter this trade we have to take a position size of $500. Now, like I explained earlier, position size is basically the margin you are about to trade multiplied by your leverage. Now, to maintain your $500 position size, you can take it with $50 margin at 10x. Similarly, you can take it with like $500 all with 1x only. You can take it $250 at 2x. So like you can see, leverage doesn't matter. So some people like they use very high leverages. So just don't get fooled that high leverage is going to give you high return, because if your position size is properly calculated, then your risk and reward both are properly managed. So whatever leverage you use, you have to reduce your margin in accordance with that, and according to that, you will lose only a fixed amount if your trade idea is invalidated. Now, next thing is risk management classic tactic. This tactic uh, has been used in stock trading for a very long time. I'm not trading on the basis of this completely. I'm using a modified version, but this is how the veteran traders manage their risk on breakouts. Suppose this is a key level. So there are three different mentalities on the basis of traders take trade on a breakout. First thing is they enter early before a breakout in anticipation of breakout. Second way is when the breakout happens, then a trader enters in a trade. Third thing is breakout happens, a pullback happens. On the pullback or retest, then the trader enters on a trade. Now, all these three have different advantages and disadvantages. For example, for anticipation of breakout, it has a better payoff since you are getting a very early entry. But the drawback is odds of bad trade are high. So it might happen that the price is rejected from the key level and then your stop loss will be hit. Second thing is on breakout. So on breakout, odds of success are increased from anticipation of breakout since breakout has already happened. But the drawback is your entry is little late since you have missed some of the move. Third thing is on pullback. So on pullback, it is almost confirmed that this breakout has happened, and you can enter on confirmation. Your entry is more probable, but the drawback is there are chances of missing the trade since in current dynamic market it doesn't happen always that you get a pullback, or even if the pullback happens, usually it doesn't go for retest of the level. Sometimes a little bit shallow pullback happens and then uh, the original direction of the move continues. So all these three styles have different advantages and disadvantages, so which makes traders confused in which style to enter in a trade on breakout. How veteran traders do it is they divide their position size into three parts. With one third of their position size, they enter in anticipation of breakout. When breakout happens, then they add the second part of the one third in their entry, and on the pullback, they add the remaining amount. In this way, they protect their capital in a better way since they are entering with only one third part in anticipation of breakout. So even if odds of bad trade are high, still you are not losing big capital. So basically, I don't trade in this methodology. I trade a little bit different manner. So that I will explain in the second part of risk management video, or in breakout confirmation and deviation video. So that's it for risk management part 1. If you have any doubts, then you can mention those doubts in the comments of the video or in the Telegram group. Thank you for watching.